events today. We are really thrilled that so many people of you joined today, and we will address a particularly important topic today. And today is not about CBDCs, a topic we have discussed in recent presentations and events. Today it's solely about stablecoins. And I think stablecoins really have a potential also to transform the industry, can make actually our life better. Of course, has also risks. But I think this is really today a really good opportunity to talk about stablecoins. And I'm also thrilled to have really distinguished speakers with us today. But before we go into the details, I would like to just briefly introduce myself to you and also the Digital Euro Association I represent. My name is Jonas. I'm currently heading the Digital Euro Association, and the Digital Euro Association is mainly a think tank around digital money. So approximately 1 year ago, we have realized that there is lots of momentum going on when it comes to digital money. And we thought, okay, we really need a think tank, which is in the middle, right? So that brings people together, that fosters collaborations, and also contributes to the public and political discourse, through research, through education, but also for just providing a network. And this is why the Digital Euro Association has been set up. We focus on 3 pillars, which are heavily interlinked. So first, education. This is also what we're doing today, right? We have an event where we educate, where we bring people together, where we bring different views together. And in the future, we will also have, we have reports. We also had a few blog posts on the ECB's recent announcement on the digital euro. Besides that, we also want to build a community and also have a really strong community when it comes to digital money. So we have currently approximately 200 of our so-called experts or fellows. So the DEA community is growing really remarkably. And as a third pillar, we want to foster collaborations here. So what we want to do is we want to bring the members of our community together and really have the situation that they also collaborate and when it comes to this different topics here. Right, so this about the DEA, there are also different levels of engagement possible. So if you think this makes a lot of sense, you're of course very welcome to join us. We have, for example, a newsletter you find on our homepage. We will also share the homepage in the YouTube chat just in a second. And as an individual, you also have 2 further possibilities, namely to join the DEA as a fellow or as an expert. What is basically the difference? The difference is that as an expert, you're basically a person that has profound knowledge when it comes to digital money. So you basically are classified also as an expert in our DEA community. And you also have the possibility to join as a DEA fellow. So this is more for the people that are currently experimenting in this topic, which are more and more deep diving into the topic, but are maybe not yet experts, but maybe soon will be, right? And this is also, of course, a way where the Digital Euro Association can help. And last but not least, we also have the possibility for companies to join. So the options I just laid out was for individuals. Now it's about companies. And here we have the possibility to join as an active member. So basically means really actively working on some tasks. So for example, working in our or participating in our working groups we will soon establish, just being part of the DEA network, get full access to the DEA community, right? So really what an active membership is when you really want to also shape and impact the current dialogue and the current stance when it comes to digital money. And the second opportunity is the supporting membership, which is basically about being affiliated with the DEA. When it comes to human resources, benefits, etc. So this is more about affiliation and using the DEA channels to also, of course, promote what you are doing and also foster getting people basically more, kind of visibility when it comes to this businesses. Right, so this is basically a very short presentation about the Digital Euro Association. As I said, if you're interested about this, you're very welcome to join us. Of course, also to check out our homepage, also our social media presence. And Yeah, I was really wanted to keep this short today because I know that we have really distinguished speakers here with us today. So first, Dr. Markus Franke from partner at cLabs, also working on the Celo project, who will basically introduce himself later on as well. Then John Elgi Eggleston, who is chair and co-founder at Monerium, and also Julian Legoc, who's currently employed with Circle, so also a very big US dollar stablecoin provider. So I think a really good mixture of different expertise in this panel. And before we kick off with the webinar today, and in particular with the keynote by Markus, we would just take a second to make an announcement, which is for us a really, really big deal. So we are thrilled to announce that cLabs has actually joined the Digital Euro Association, both as an active and a supporting member. So here again, thanks to you, Markus, of course, for supporting this, and also to Anka Russu, who was really a driving force when it came to making this partnership possible. So thanks again. We are really looking forward to work on this, to jointly work on this road to digital money with you, and are really, really thrilled to announce this today, and also Markus to have you today as a keynote speaker and a panelist of the Digital Euro Association. Right, so that's actually it. So without further ado, I would like to hand over to you, Markus. So the agenda is the following: that we would like to, or that we are having a keynote which introduces stablecoins. So this basically gets us all on the same level of stablecoins. So what are stablecoins, which forms exist, maybe also outlining some benefits, some risks, before we will then later on do a deep dive into more sophisticated and more deeper and more debatable aspects, I guess, also from stablecoins. And before now really handing over to you, Markus, one last comment, which is about questions. So of course, we would like to have this whole section and session really interactive. So if you have any questions to the panelists, or to us, whatever, then you are very free to ask them. And here we would ask you not to ask them via the YouTube chat, but ask them via Slido. So what you can do is you can just scan this QR code here. This is the first alternative. Or the second is you can go to slido.com. You can insert here the event code, which is 377368. And then you actually see a screen where you can insert your question directly. And this is a quite nice tool. Also, in a quite democratic way, we in the end will just answer the question with the most likes we can do in our 15 minutes time frame. So we also ask you, if you have questions, of course, to ask them, and also upvote other questions that we see which questions are probably mostly liked and preferred by the whole community here. And last comment, really last comment, if you have a question which is allocated or should be allocated to a specific person, then please also name the name of the person so that we know who to ask in the Q&A. Great, so that was really it. Thanks for listening to me, and I would now directly hand over to you, Markus, and to your keynote on as an introduction to stablecoins. I'm really looking forward to hearing your views, and of course, you're also very welcome to first introduce yourself and tell us what you're doing and how this relates to this topic of today. Thank you very much.
Perfect. Thank you, Jonas. Can you see my slides full screen?
Yes, perfect.
Perfect, great. So thanks for the intro on the topic. We are also very excited about the partnership between cLabs and the Digital Euro Association because we see a lot of potential for stablecoins, especially in the Eurozone as well, complementing the digital central bank Euro discussion. Actually the second stablecoin after the launch of the Celo dollar on Celo was the Celo euro, a stablecoin, as the name suggests, that follows the value of the euro. So that again shows why we are excited about the euro area. To start, as an introduction, let me see. Okay. That's the second one. Jonas, you already mentioned it. My name is Markus. I'm working on Celo at cLabs. Celo is mobile, open, and real, with the mission to build a financial system that creates conditions for prosperity for everyone. And mobile means Celo is mobile first. It enables transactions from, for example, low-end mobile phones. It is open source and permissionless. It is proof of stake, and it empowers real use cases. I can send today already a Celo Euro. This is the stablecoin that follows the value of the euro with my phone to any phone number around the world. It arrives within 5 seconds. It costs less than a few basis points in fees. And I just need the phone number of the recipient. But today I would like to talk a bit more in general about stablecoins and why they exist and if they are actually a game changer or just hype. And having access in general to stable currencies can actually make a big difference in many areas of the world. I think this is a part of the story why cryptocurrencies emerged, that many projects in the space talked about. Not everyone in the world has access to stable currencies, not only because of inflation, but also because many people in the world don't have access to a credit card or a bank. So for example, this gentleman here on the slide is Kaburu. He lives in a refugee camp in Tanzania. And the challenges he faces are similar challenges many people there face as well. He is one of 1.7 billion people in the world who are underbanked, and one of 1.1 billion people in the world without a formal government issued ID. And if he wants to send money across borders, then he needs to pay a fee of $15 for this remittances. If he wants to send a transfer within borders, then he faces costs of up to 20%. So when we innovate on money, be at Celo or the fellow projects of this panel later on, or the overall industry itself, what they can do and what we can do is actually build a more inclusive system that changes these fees people have when sending money around the world. Stablecoins can actually do that. They can do so much more. You could imagine, for example, also a universal basic income based on stablecoins when you tie stablecoin usage to an identity protocol. You could also, for example, in times of recessions, think about using this technology to incentivize stablecoin transactions and therefore encourage circulations of stablecoins via fees or incentives to support the economy. You could also think about nature-backed currencies, stablecoins that are actually collateralized with things that we would like to see more of, for example, stablecoins that are collateralized with healthy forests or clean water. Or you could also imagine local stablecoins, global stablecoins for certain use cases, and so much more. But why actually not just use any crypto asset, but like talking specifically about stablecoins? And we talk about stablecoins because two of the features of money in general are being a medium of exchange and a store of value. And when we look at the money implied volatility of Bitcoin, which ranges sometimes between 50 and 250%, we can see that sometimes using Bitcoin, for example, as a medium of exchange can be hard since it's relatively volatile. And therefore, the industry came up with this concept stablecoin that in a very broad definition just has less volatility than some of these assets. But are stablecoins actually always stable? And the answer is, it depends. We can find examples in the industry that haven't been stable and for different reasons haven't been stable. So the slide here shows a stablecoin that follows or should follow the value of the US dollar, the IRON stablecoin, which is actually a seigniorage type stablecoin. And I'll talk in a minute about the different types of stablecoins. And this IRON stablecoin can be minted via Titan, which is the seigniorage asset. There was a time where there was less use for IRON stablecoins. So IRON stablecoin minting was incentivized via Titan. But when the price of Titan, the seigniorage asset collapsed, also the price of the stablecoin actually collapsed. And when we zoom out a bit and look at other stablecoins, we can see some of them have been more stable and some of them have been less stable. And it also depends a bit on the period of time we look at. So on the slide, you can see many different familiar names, USDT, USDC, Binance Dollar, DAI, UST, FEI, the Iron stablecoin I just talked about, and also the Celo dollar. And looking at this slide, you can see some of the stablecoins did pretty good in long periods of times. Some of them saw some depegs based on different reasons. And you also can see that all of them on this slide are actually following the value of the US dollar. So not many euro-based alternatives we see on this slide here, for example. There are different reasons why there are not so many euro-based stablecoins, and I'm sure in the panel later on we will touch again about topics around innovation in Europe. There can also be, especially for fiat-backed stablecoins, one of the reasons is a very simple reason. Looking at the interest rates in Europe and the US, you can see over the last years, and probably know that interest rates in the US have been positive. What we can see on this slide here is the effective federal funds rate in the US, and also the ECB deposit facility rate for the euro area. And most of you are aware there are different interest rates out there and difference that are interesting to look at. But looking just at these two rates, it already shows that the US rates have been positive on average and the European rates have been negative. And as a issuer of a fiat-backed stablecoin that holds fiat in a bank as collateral for this stablecoin, I actually earn the area below this red line. I earn interest income on the collateral. And this, for example, could cover the cost of issuing the stablecoin, distributing it, and developing the stablecoin. Issuing a fiat-backed stablecoin in the euro area as an issuer is more difficult because I have a negative interest rate, and it could be that I have to pay this interest rate on the credit that backs the stablecoin. And therefore, this could be one of the reasons why we see more, especially fiat-backed stablecoins that follow the US dollar, but there might be more reasons we're happy to go into later in our panel. So differentiating different types of stablecoins is not so easy. This is the differentiation framework of the Bank for International Settlements, which already shows there are many different categories based on which you can differentiate between different stablecoins. You can differentiate by user interface, what wallets are out there for the stablecoins, or what service providers allow access to these stablecoins. You can also differentiate by the transfer mechanism that the stablecoin relies on. Is it a stablecoin that is based on DLT? If it's based on a decentralized ledger, is it a permissionless ledger, or is it a permissioned ledger? Is it a fully public or a private stablecoin? Private stablecoin could even be a stablecoin that focuses on certain use cases versus a public one that can be used for anything. Is it a hierarchical or a non-hierarchical? Is it an open sourced protocol versus a closed source? And then there are also differentiation based on the stability mechanism of the stablecoin. So who is the issuer of the stablecoin? Is it a central bank? Is it a protocol that is decentralized, or is it an entity? If it's an entity, is it a regulated bank, or is it based on a promise that there might be a bank somewhere holding collateral? And there's also different types of stability mechanisms that underpin different types of stablecoins. And looking at these different types of stability mechanism, to make it very general, you could differentiate stablecoins in these four broader categories. So there are a lot of fiat/commodity collateralized stablecoins. Fiat collateralized stablecoins are actually what the name suggests. They are stablecoins that have fiat as collateral. Therefore, the peg to the currency they are following is implemented via the collateral. Basically, these stablecoins hold collateral in form of fiat in a bank somewhere, which means there is some centralized element to governance of these stablecoins. There's also some, or could be some, regulated element to governance of these stablecoins, because these banks should or could be regulated, which means the transparency in these cases is maybe not based on blockchain technology, but could be based on audits of the collateral of the bank, which then in the end also means the major risks that are governing these stablecoins are in the end counterparty risks or liquidity risks of these stablecoins. So the stablecoin, a fiat-backed stablecoin, is collateralized by bank credit, and therefore there is a credit risk, and this credit risk depends on the bank that holds this collateral. Then there are other types of stablecoins. There are crypto collateralized stablecoins where the collateral is not bank credit, but a crypto asset. So the examples I have here on this slide for fiat-backed stablecoins are Tether and USDC. For crypto collateralized are DAI. The first version of DAI is purely collateralized by ETH. So here the transparency could be higher since the collateral is based on blockchain, and therefore also governance can be decentralized. However, the risk now is a different type of risk. It is based on the volatility of the collateral. So you have a higher crypto risk in these types of stablecoins. There are seigniorage share stablecoins, where basically a seigniorage asset takes up the volatility of the stable asset. Examples for these are Basecoin, Terra, also Fei. And here, the stability depends on this seigniorage asset. And then there are these algorithmic stablecoins, which can be a hybrid between crypto collateralized and seigniorage share, like, for example, the Celo Euro and Celo Dollar. Most of these stablecoins have one common risk, and this is demand risk. Because if in the end there's varying demand hitting a slowly changing supply, then the stablecoin can depeg. And this is also what we have seen for many of these assets out there. If there are severe depegs, it could be that there's just no demand for the stablecoin, and therefore the price drops. Or it could be that there's more demand for the stablecoin than supply out there, because maybe the mechanism that issues the stablecoin called back a lot of stablecoin, and there's more demand than supply. And then, and this is going into economics, and we probably don't have a lot of time of going too deep into that. Then it depends on the demand function that is governing the demand of the stablecoin, how severe or how far away from the peg then the price moves. So in this case, if you look at the intersection between the green and the blue line, here demand equals supply at the price of $1 with a supply of 20 million stablecoin. If the supply would only be 19 million stablecoins, so there would be less supply than demand at the price of $1, then there would be a higher price for the stablecoin, and how high the price would be would depend on this demand function. It is very hard to make an assumption on this demand function. Therefore, we have seen many stablecoin protocols that try to use auctions or other mechanisms to match supply and demand fail, because it is just hard, and auctions can be slow. And therefore, we could actually see that market-based mechanisms in the past actually always worked better. I talked a bit about the demand for stablecoins, and finding real use cases might be very important for the different types of stablecoins. And therefore, I actually want to make a case for mobile first stablecoins as well. Maybe also the reason, or one of the reasons, why Celo focuses on mobile adoption and is a mobile first protocol. Worldwide, we see today already 8 billion smartphones circulating. And based on this data in the Ericsson mobility report on worldwide mobile subscribers, we see that not only the number of smartphones in the world is going up, but also good connectivity in many different regions of the world is going up. So you could actually see that enabling stablecoins on smartphones actually can be can be something that brings more users, more adopters to this technology. And then one last point, which we can also discuss a bit more in our panel later on, is about trust. So the example I would like to talk about here is actually a universal basic income pilot in a community in Brazil. This project here is run by Impact Market. Impact Market is distributing a universal basic income to this community, which means community members get Celo dollars on their mobile wallet, in this case, the Valora wallet, every day. And this wallet allows them then to send and receive, to do transactions, payments, or maybe even saving. What we could see in the beginning was nobody trusted this in the beginning. So what they did, they went to the community manager basically every day when they received their universal basic income to cash out immediately. Because in the beginning, there was no trust in this digital token. But after they experienced over some time that they actually can cash out every day, and it actually works over a longer period of time, they started to hold on to it. Some of the community members there started to save. Some of the community members started to do transactions with each other or make purchases at local stores. So over time, you could actually see that this community got used to, in this case, the Valora wallet, and it actually became a loved part of the community there. Based on this universal basic income part. So we could see that also there, more and more people adopted this technology. So I only had 20 minutes. I hope I stick to it more or less. And I think now it's time to kick off our panel discussion. Thanks a lot.
Perfect. Thank you very much, Markus. Perfect on time and really insightful. And I think it really provides a very, very good and solid basis for this panel, which will now take place. So as I said in the beginning, please, if you have any questions, use the Slido. We also shared the link in the YouTube chat. So feel free. We also have seen you already. We already have received some first question, which is really good. So keep doing this. Great. So now I'm also very happy to introduce Julian and also John, who also join us with the panel. And I would actually directly hand over to you, John. Maybe you want to introduce yourself really quick, so maybe in a minute, and explain how your work relates to this topic of stablecoins, and then we continue with Julian doing the same.
Yeah. Okay. So I represent a company called Monerium. And what we do is we offer regular money, just the fiat money on blockchains as e-money tokens. And we regulate it and authorized to offer the service within Europe, the European Economic Area. And so we don't like to use the term stablecoin. Sorry, guys. But we use e-money because e-money is quite different than stablecoins. But basically, you have just regular money on blockchains as e-money tokens. So that is what we do. And then recently we announced that we have integrated our system with the European payment system, SEPA and SEPA Instant. So basically, you can control your e-money tokens through a regular bank account that we provide. So that is because we believe that this token economy is going to go and is going mainstream.
Great, thanks, John. Maybe Julian, want to continue?
Sure, thank you, Jonas. It's an honor to be here with such great panel members today. And Markus, thanks for the introduction. And I think we could probably coin a smart stablecoin that is a stablecoin that could operate on a smartphone. I think like we should coin it during this. But really happy to be here today. I have Europe at heart. I was born in France, raised in Switzerland, and I'm participating today from Washington, D.C. And I represent Circle. You may have heard of Circle, but as with Markus and John, I'm going to follow suit and kind of give the mission of Circle is to raise global economic prosperity through programmable internet commerce. But we are better known for being the principal operator of USD Coin. It has currently about 27 billion in circulation. It's the fastest growing stable coin. I'm sorry, John, I'm using stable coin and not e-money. But we have over 750 billion of transactions on chain this year, and very much looking forward to this discussion. Jonas, back to you.
Perfect. Thank you very much for this introduction. So I think we really have, lots of diverse backgrounds here in this panel. And maybe I would say regarding terminology, I mean, we hope that these stable coins and e-money dimensions might be combined or merge in the near future. And John, I would say like if Mika is a place, or maybe assume at least for today, we consider both, right? If you think this is appropriate. If not, you can of course interrupt me here. Right. So maybe let's start with a very general aspect. And Markus already has touched on it. What do you actually think are the main use cases of stablecoins? Because I think this is really essential also for people to understand. We have PayPal, this seems to work, right? We have Apple Pay, some people use cash, this seems to work. Why do we need stablecoins? Markus also started with this international cross-border dimension, which is really crucial. But maybe building on this, what are, from your perspective, further use cases for stablecoins? And here, this question is open for anybody to answer.
Yeah, if I can start, whether it's stablecoin or e-money tokens, then I think one of the aspects that is sometimes overlooked is the importance of e-money tokens or the tokenized economy, basically to make our financial system safer. And I say this as a former central banker and someone that experienced what happened in Iceland in 2008, where the whole banking system collapsed. So one of the things that is happening when you have stablecoins or e-money tokens is that you are, in a sense, unbundling payments, money creation, payments, and banking. And one of the fundamental problems with banking is that you have too big banks, too big to fail banks, and that is because we all depend on keeping our money with the banks. So if you can unbundle that and you can be in self-control of your own funds, I mean, that's a huge benefit. And even if the bank will go bankrupt, you are not affected if you are not depending on holding your money at the bank. So I think this is an aspect. This is something that is very often overlooked, but I think it's a tremendous opportunity to make the financial system much safer by using this technology. But in order to do so, then you have to make sure that this kind of money is safe money, and that's and there are many aspects that you have to look into there. Of course, it has to be, in my mind, just has to be regular money. And you have to make sure that the consumer is protected. And that means that this has to be regulated and make sure that, you know, the one that are providing the service, they are following the rules. And we're so fortunate in Europe to have a fantastic framework, the e-money directive, to basically guide us in that, how this is done. This is an old legal framework, 20-year-old framework. where it's supposed to be technologically neutral, and the focus there is to make sure that it's safe for the consumer.
So I guess I'll add a little bit. Completely agree with what John has been saying, and Markus covered kind of the cross-border use case. But I'm going to give you an even more very basic practical experience I had just a couple of weeks ago. A friend of mine was married in Mexico, and so I traveled to Mexico, and I was paying for dinner, and on the check they actually had the cost of transaction of payment. And if I decide to use a Visa, I had to pay 3% more on the bill. And if I had to use American Express, I think it was 5% on the bill. And then if I paid in dollars and not Mexican pesos, then I actually got a slight discount on the bill. And so what I would have loved, of course, is to pull out my phone and just pay with a stablecoin where it costs the merchant practically nothing. It costs me practically nothing. And then the transaction is settled in just a couple seconds. What is currently unknown to most consumers is when you go for a particular payment in day-to-day consumers purchasing goods, you walk out of the coffee shop, for example, in the morning, very happy with your caramel macchiato, but that particular merchant only gets that money, whether it's a euro or dollar or another fiat currency, approximately 3, 4, 5 business days after you've already left the shop. You as a consumer, this is transparent, but the merchants are paying for that particular fee. So stablecoins add one more layer of optionality to the consumer that is more efficient, much less friction at lower fees. And so although remittances still cost on average 6.8%, Markus, you covered the 1.7 billion that are unbanked. There's about that same amount that are underbanked. So you have almost 3 billion individuals that could benefit from using these type of digital rails, digital payments. And at the end of the day, I really think that it is the consumer that should have a choice on what type of payment rails they want to leverage, and stablecoins offers one more option.
Fully agree on all of these points. I mean, remittances are costly everywhere in the world. Payments are as well, and this can actually change this. And there's even more. Stablecoins can also enable, in many different countries, lending and borrowing in different types of currencies, what we already see emerging in this whole space that is called DeFi or Decentralized Finance. You could also imagine more and more also micro work applications where people earn small amounts of money in different parts of the world based on different tasks, and would need to be paid, or could now be paid in small transactions, because now transactions are much cheaper. You could also imagine charity organizations that now much easier and cheaper could send money around the world without having the need for an army that protects basically the money they send in different regions. And it also enables saving in areas where people haven't been able to do that. And then this whole layer that comes on top, this whole smart contracts that make conditional payments, for example, possible. That is also super interesting, because now you could have a payment in a stablecoin conditional on something, on some work being done, or some condition in an insurance contract being met, and so much more. So a good future we probably all three see for stablecoins.
Yeah, excellent. Thank you very much. So then we have, to kind of quickly summarize, we have like cross-border payments, so mainly financial inclusion and payment efficiency. A safer kind of a payment system, what John raised. So basically unbundling payments and banking. Also more efficient payment system itself, lower transaction fees, so faster settlement, also lower costs for merchant, what Julian said. Diversity in payments, I think, is important, like enabling, driving all these DeFi projects, right? Lending, borrowing, etc. And what you said last Markus, programmability of payments, how I would call it. So basically having DLT-based applications that can not just process some kind of like non-financial data, but also can process data, which derives, or promises lots of automation and efficiency gains, right? Great. So I think this is really a good starting point to see why stablecoins matter, what they can do. Of course, there's also this side, obviously, of risks, right? So I think risks are Markus started to sketch this. So maybe to start this question again, what do you think are like major risks of stablecoins? Or do you think, well, the benefits are way more severe than risks there are from your perspective, not really severe risks? I would really be curious in your views on this one. Of course, stablecoins here again is very broad, right? But you can focus or answer this for all kinds of stablecoins.
Was that me or?
Like everybody, again, you can go ahead if you want.
Yeah, okay. So I think the greatest risk so first of all, I think stablecoins are important, don't misunderstand me. And I think it's really beneficial, the way it's used all around the globe. But I think we shouldn't neglect the risks regarding to stablecoin, which has to do with governance, transparency, and stability. These are all important issues which can be solved with a global standard. If we would have a global standard where those issues are addressed, we would be able to offer this service around the globe in a safer manner. And I think that's I just think that is what is needed to be done over the next few years, I guess, for global policymakers to basically come up with a global standard. And I happen to believe that the best standard, to re-emphasize, I think the best standard for e-money tokens or stablecoins is the e-money framework in Europe. And it is interesting to follow what was going on in the US last week, I believe, in the hearings and the requirements and the concerns that were raised. Most of these issues are addressed in this framework. But as I said, governance, transparency, and stability is of course a major issue for those services.
So I guess I'll ride on the really good rails of John. I think he hit on the main points. And if you ask a risk guy, which I am, I guess it's a nuanced answer with my risk tolerance level and my risk appetite level. But around stable coins, we have to remember that the technology is still a complex technology. And I equate it to even when the internet came out. I remember my father seeing me install my AOL disks in the computer and telling me that the internet was only for bad actors, and the only benefit I would get from internet is, all the nasty things like all the gambling and all these stuff going on. But I think the particular risks around the privacy, I think are very real. As you know, today, if you walk out and you pay someone with cash, there's absolutely no trace, and some people want a lack of traceability, whether it's a personal belief or whether you are actually doing some type of nefarious act. And so with stablecoins, I think the option of having a privacy built into it could pose potential risk to the individuals or the companies that are holding that type of data. And this has been something that I think central bankers around the world have been wrestling with, as well as ensuring that you have proper security controls in place. Anytime you're dealing with any type of consumer data and consumer money, as some projects are, then you're going to need to ensure you have appropriate controls. So I think the risks really lie with companies that are in the particular space, but it's also a consumer choice. Clearly, if you look at my credit card bill the past 2 years, you know exactly where I've been shopping at. So I guess Visa and MasterCard and American Express, they know exactly what I've been doing with my money the past 2 years. And I allow it because I am allowed to I signed a user agreement that was probably too many pages for me to understand, and not being a lawyer, it's above my pay grade. But I would see really the privacy and the security as the two largest risks.
It's a very good point. But I actually like that the technology delivers or offers the option to either grant full privacy. CK snarks, for example, are or is a technology that enables private transactions. But on the other hand, as you said, if there are concerns by the regulator, or if this should be regulated, if the transactions cross a certain limit or cross a certain size, then you could also make it less private. And basically this technology offering both options, therefore has again a lot of potential.
This goes again back to this diversity argument that I think Julian it was raised, right? So that you have like all these possibilities now with stablecoins and DLT based means of payments, right? So some are more private, some are less private. But yeah, chances are definitely there, but I agree, and that you also raise the risk. Let's maybe come a little bit more practical, and let's come to the adoption question. To prepare for today, I did again some research about Euro stablecoins, and here you basically see that currently, if I wasn't mistaken, I think in top 20 there was one Euro stablecoin. This was a Stasis Euro at like position 17 or something. So I think US dollar makes, I don't know in percentage, but a lot compared to the euro. Let's keep it like that. And here my question to you would be, because I'm realizing this, and I see that Euro puts up a legal framework for stablecoins as well. But I also see for the last few years, the difference between the US and Euro, at least from my perspective, has seemed to be become bigger and bigger. And here my question would be to you actually, why is Europe, I mean, first question, does Europe lag behind? And if you say yes, why? So what are the reasons why Euro stablecoins have not yet reached really substantial market size? And maybe as an additional question, is this solely due to these negative interest rates also Markus referred to? Or are there other, maybe also more severe issues that have basically been hurdles for the adoption of Euro stablecoins?
And maybe the negative interest rate story was just like one of the reasons why it might be harder to issue a fiat-backed coin on Euro, because of the negative interest rate. It's just tough to finance basically operations based on negative interest rates, since this is then an interest rate that the issuer in the US-based stablecoin actually earns, and the issuer would have to pay for the Euro stablecoin. But yeah, I'm very sure that my fellow panelists have more ideas why Europe is a bit behind.
I will gladly tackle it. And Markus, I think you're right with the negative interest rates, the geo-economic issue. I'm going to go another factor that I think is an add-on to this. The largest factor in my mind is around funding and private funding, and the lack of private funding that we see an investment in the EU. And this has been around for many decades. And on top of the funding, it's transforming that funding into revenue. And so I see in the US, they're very good at transforming private funding into revenue. And let's not forget that Europe actually has the largest public R&D investment in the fortress nations. So I think the investment is there at the public level, but how do you transform it into revenue and into businesses? And I guess the last thing that I'll state, when I was working in London for about 4 years, this was really apparent to me with my experience there. But the three-legged stool that I also see is in Europe, there's like this culture that is fairly risk averse. And then you have policy that is risk averse, and then you have the regulation that is risk averse. And then you have this perceived lack of cross-border unity between the EU 27 that sets in, and you have one country that says, well, what is this other country going to do? And so it's this perceived lack of unity. But I think the lack of interest rate is just one more factor that adds that. And I know, Jonas, you didn't go into percent, but I'll give it to you. It's close to 99%, unfortunately, US dollar-backed stablecoins against Euro stablecoins. But there is some positives, and we talked about it just as we joined in kind of the back channel. But like the euro stablecoin has been growing 2 times the EURS, I believe it's called. I think it's close to 100 million. So it's been growing, and slow and steady could potentially win the race. And let us not forget also that the world reserve currency, the US dollar, is usually at 70 or 75%, but over the past 25 years, the lowest it's ever been is the last quarter, with the US dollar world reserve sitting at around 59%, according to the IMF. So perhaps there's a change in sentiment there as well, and that euro stablecoins could potentially start gaining ground. But I'll turn it over. Would love to hear what John has to say on this.
Well, first of all, then, of course, as we know, then the US dollar is the dominant currency of the world. And so I think it should be, and it's, I think it's natural in a way that it's reflected in the issuance of stablecoins, which is now above 100 billion at least. But I also think that the European Central Bank is making, shall we say, mistakes in many ways. Because negative interest rates, I mean, I agree with what Markus said, that the negative interest rates, they are not easy to work with for those that are offering the service. I mean, you have to safeguard the underlying funds, and if you're losing money by that, then it's not a profitable business. There is a lack of incentive. But we seem to forget that this is intentional by the European Central Bank. The European Central Bank wants the people and companies of Europe not to hold euros. They want them to spend it. They want to support the economy and increase the velocity of money. So this is a monetary policy issue, that they don't want people and companies to hold the euro, spend it, and they're succeeding. And that shows also in stablecoins. You know, who wants to hold the stablecoin in euros when it's basically diminishing by the day? So and then I think it's interesting that the European Central Bank at the same time says, well, we have a problem because not enough people are holding euro, shall we say, stablecoins or whatever, but they are contributing to the problem, and then they want to solve it. And that is my second point, which is also important. If you are building a company and you want to service Europe and you want to provide the euro to Europeans, then if you have a central bank which is saying, you know, and has been saying now for some time that, you know, they think that they are well suited and maybe best suited to offer the service, well, who's going to compete with a central bank if that would be the case? So I think they have to be, first of all, I don't think it's a role of a central bank to issue retail CBDC. I think the private sector is much better suited to lead in technology and business, and the central bank has basically no role in that. I think the role of a central bank is to support the wholesale CBDC and support stablecoin projects or e-money tokens. I think that is the proper role of a central bank. But the message that has been coming out of the European Central Bank is, you know, yeah, we might offer this to the general public, and then that's basically saying to investors and companies servicing Europe, are you going to compete with the central bank? Of course not. So I think it's a problem of negative interest rates affecting both the service providers and the interest of people of holding euros that are losing value by the day, and then the mixed conflicting messages from the ECB, which is not helpful as well. And then I think the approach taken by the Bank of England is quite interesting. They seem to be forward-looking in this, and they want to support the private sector. Actually, there was a report, I think last year, I think it was in October, where it was clearly stated by several central banks, including the European Central Bank, that one of the design criteria for CBDC would be to basically facilitate the private sector to participate and work with the central bank. I think that is the right approach, but then the message has to be, you know, coherent with that.
The point on the negative interest rate is a really good one also for this technology, because with a negative interest rate, as you said, the central bank can basically incentivize people in Europe to spend their money, but it's a very non-targeted approach, because basically it doesn't differentiate. So there's basically a negative interest rate on any cash holding, and it would incentivize any spending that could then inflate some asset classes and prices in some areas. In others, it doesn't. There was this interesting approach of demurrage by Silvio Xell in Virgil, which is a very targeted approach to incentivizing transactions by having a fee on a token or a coin or on money if people don't transact. That very specifically incentivizes transactions, and that could be done in certain industries, that could be done in certain areas. So that could be more targeted with this technology. This is why this concept of demurrage is part also of the initial Celo white paper, because it would actually be possible on a digital currency, and would therefore also offer a central bank, if it adopts a digital currency, it would offer actually more possibilities to make monetary policy, because now they could incentivize the turnover of cash in certain industries or geographies. And the other point I want to add, so it's a good point, a good thing that Celo Euro is now live. We really would like to change that there are less euro-based stablecoins. So yeah.
Good mission, I guess.
So I'll add one last thing, Jonas, and I'm sure then we need to skip. But I completely agree with what Markus and John was saying. You know, central banks operate with private sector banks, right? And so they're inherently non-market based. And I also believe that you know, when central banks are thinking about digital currencies, they really need to look at the wholesale type of CBDC. Because 99.9% of individuals, you know, don't have an account with a central bank, and that's where I think Markus and his proposal, what he was talking about, makes a lot of sense. Most money in circulation today is private issued money on the two-tier banking system. It is not central bank money, and if you walk into your bank today and you ask him for even 5,000 euros in cash, or 10,000 euros, or 20,000 euro in cash, they're going to look at you and they're going to say, "Oh, I'm sorry, we need 2-3 days to get that money together for you." Correct? Therefore, I think what we're looking at with the advent of stablecoin is very much private sector leading innovation, much like we've seen private sector leading innovation over the past 50, 60 years with things like plastic and charge cards and credit cards. And you mentioned, Jonas, PayPal and Apple Pay and Samsung Pay and what they've managed to do. These were not central bank innovation. Now they have public-private partnership, which I think is critically important. And I think, Markus, with your example, that's exactly what you were alluding to. But again, I think this is co-opetition. This is not competition between a central bank and the private sector.
Yeah, this is really interesting aspects you just raised. Also, this private-public partnership, and of course also ECB's monetary policy. What I would like to discuss next, because if I understood you correctly, and Sean and also Julian, is that you would basically say that if, let's assume now that there will be a digital euro soon, right? So that the ECB decides to issue, I mean, soon is another question, but there will be one, and decides to issue such a digital euro. Do you think that this is a threat to stablecoins? So do you basically think that this would substitute like the importance and the adoption of stablecoins? Or do you think that both would like coexist and would also address different use cases, again, to everybody? Not all at once.
So I guess I'll take that. When I was talking about co-opetition, this is an all ships rising moment. Central banks have a particular role in the economy, and I don't think the private sector is trying to take over that role, right? As you know, the private sector tends to move quicker than central banks. But between us, even with the ECB announcing that they now have a 2-year pilot program. When you look at around the world, we only have 5 CBDCs. We have about 10 or 12 that are in pilot stages, and the rest are still trying to research it. It would operate very similar to the way it operates right now. So the big money that is transferred around the banking system, the central bank is part of it, correct? So if you become a bank, you have an account with the central bankers, and then you transfer money that particular way. The rest of the economy at the consumer level benefits from this private sector money, or from a single currency stablecoin would be my choice. And Markus, you talked about algo-backed stablecoins and commodity-backed stablecoins and fiat-backed stablecoin and multi-currency stablecoins, and I'm sure there are going to be many more that come our way. It's really not competition with central banks. And in fact, in a perfect world, when you take a look at large-scale innovation, take a look at the advent of the internet. The internet wasn't just a private sector innovation, correct? It was a public-private partnership that came out with the innovation. You look at telecoms, very similar to that. Today, there's interoperability between telecoms, but there are not between payments. So I really don't think it's competition with central banks. They play in a very different role than the private sector innovators, which we have today here with Jean and Markus.
Fully agree on this point, and exactly the point on interoperability in the end then is key. Is you can have all these different currencies and types of money and other things out there, as long as in future these different systems can talk to each other in a better way than in the past, that there is some interoperability between different blockchains, but also between central bank solutions and private sector solutions, and then maybe decentralized solutions that can enable so much more. And therefore, I think, yeah, interoperability here is key.
So I agree with my panelist. I think there's opportunity for central banks to work with the private sector, and I don't think that's much different from what has happened previously. We see, I mean, we have some examples from history. For example, Julian mentioned that the mobile industry is an interesting example. In 1983, then Motorola had a very successful mobile phone. It was used, but it could not be globally used. And that was 1G generation of mobile networks. And it was when the second generation network for mobile phones came out under the GSM standard, which is actually something that was, the standard is a European standard. It's not about the technology, it's about the standard. And that came out in 1991. It was about 8 years later. Then, you know, the US Motorola company had this success with their phones, but it couldn't operate globally in the same way as we are using now mobile phones under the standard. The same thing in my mind is going to happen with money. I think I think there will be money on blockchains, just like we have money on debit cards, and there will be a global standard. Yes, of course, the central banks will have a role there because they are managing the money supply indirectly through banks, even though the private banks are creating the money through new lending and so on. So I think, obviously, I think this is just a story that is evolving, and I think will go through a similar path as the mobile networks. We need the global standard, make it operable all over the globe, but then we need to have the standards.
Excellent. So then actually you seem to be pretty aligned that there is need for both, right? There is a private public partnership to work on it. Interoperability, standardization are really severe aspects to consider, and which has to be ensured. Also what you just said in the end, Sean, have a global standard on this topic. Before we turn to the Q&A, I would ask you two last questions. And here again, everybody can ask, or just specific ones of you. It depends on you. And one aspect we have touched a little is the aspect of regulation. right? And this is something where like policymakers or regulators in Europe say, well, in a few years, we have like a landmark regulation for stablecoin. But I also know that there are skeptics say, well, we should have done this differently. So this maybe to give you a little bit background, or at least the audience, is that the European Commission has proposed the markets in crypto assets regulation, which includes a lot of regulation about crypto in general, as Bitcoin and Ether, etc. But also I want to focus on these stablecoin aspect, because here it basically says that if MiCA is adopted later on, it's currently not, but later on, then stablecoins providers have to comply with an e-money regime, as John, for example, described it, right? And this would also demand that a euro stablecoin would be indeed fully 100% backed with euros, at least if it's like Markus, not an algorithmic one, but just like a normal fiat-backed one, right? And here my question would be to you again, maybe John, having you as the first respondent. What do you think about this regulation? Do you think this is a good step that Europe has taken, also maybe increasing adoption of stablecoins, or do you think no, it's too rough, or maybe also not good enough from your perspective?
I think the MiCA proposal proposed by the EU Commission is positive in many ways. It basically will ban stablecoins in Europe, and you have to be an e-money issuer. I think that's a positive step. I don't like all of the things that are in there. I think we have already a pretty solid framework for this. This was, I believe, I don't know, I'm speculating, I think it was in some way a response to Libra. And you can see that if you read the text, they're concerned about the one major player dominating the market and so on. So I think they are maybe a little bit too skeptical in this proposal. So we'll see what happens. But in general, I think it's a good step to basically, you know, if you have laws saying that in order for you to issue money, real money, you have to comply to this legal framework, and then it doesn't make sense if other solutions are allowed to operate as well, because it is it's restricting to operate under this framework. And it's not only, as you mentioned, Jonas, that this is 100% backed. It's not only 100% backed. You also have to contribute with your own equity. So it's more than 100% backed, but in general, it's positive.
So I'll add a little bit to this. Clearly, you know, MiCA regulations still has to go through the whole legislative process, so it may take another 18 months, another 20 months. And a lot can happen in this particular space. I think the alignment to e-money is an interesting one, because I believe, Markus, you were alluding to a negative interest-bearing account. In e-money, there is no interest, correct? The e-money regime says you can't apply interest on that. So I think the MiCA regulation has two really, really good things. One, the passporting nature. One, having clarity in the space. As a risk guy, you always want clarity. So I applaud the EU for at least getting their thoughts down on paper. So clarity is big. Passporting, being able to go across the Euro 27, I think is a good thing, as well as making one body, the EBA, although with the refinement of the regulation, they also wanted to make sure that the ECB had a seat at the table. But I think having one regulator being able to go to it instead of multiple regulators are also a good one. Now I'm going to talk about some of the challenges that I see. One of them, it firmly favors incumbent financial institutions over fintech startups. And the challenge I see there is that such a heavy regulation with a lot of investment needed is going to push innovation offshore, which I don't think that was the intent of this particular regulation. I think, in fact, they were welcoming fintech firms. And then the other thing is, and I'm not a lawyer, so please don't take this verbatim, but under the e-money directive, there are these regimes that are called like small regimes or sub-threshold regimes. And because of that, tech entrepreneurs might interpret that as too difficult for us to launch a product in Europe, and therefore they might go elsewhere. So I think overall, I really applaud and appreciate the transparency and getting down on paper. I completely agree with Jean that I think that regulation was aimed at one particular project which I was with for almost 2 years and have a lot of bruises and gray hair, like Jonas knows. But overall, I think having clarity is better than no clarity, and would commend the ECB for actually putting thought to paper.
If I may, I would like to add that we have pretty good clarity for Europe now. Just, you know, basing this service on e-money, the e-money framework. We have one regulator. You apply in one country, and then you can passport to the other nations. That's exactly what we have done. But I think it's. I agree with you, Julian. It's a little bit overboard and too heavy. And obviously it was aimed at Libra, in my mind.
And in this MiCA, you have the e-money regulation for e-money tokens, basically tokens that are referring to the value of a fiat currency that is legal tender and is maybe backed directly by fiat. But in this regulation, there's also utility token and also asset reference token. And this asset reference token could also be stable currencies or stable tokens in some form. And I think especially here, we need a bit more clarity. If there's no central entity that holds fiat, and therefore we have a e-money token, but we have a fully decentralized system, how then it would look like. And I fully agree, having more clarity here and having a regulation that favors innovation and yeah, is always good.
Thank you for your perspective on this regulatory question. Yeah, we are really good in time, so maybe the last 5 minutes, so the last round before we go into the Q&A, and I would a little bit more talk about like the outlook. So I mean, in particular, what do you think, which hurdles have to be overcome that the adoption of stablecoins, in particular Euro stablecoins, will increase in the next the next few years, I would say. So maybe everybody 1 minute or something, so quite short, but I think this is a really interesting question to see what now. I mean, if politicians listen to this and regulators, like, what should we do, right? So I think this is like the question everybody wants to get answered.
So I think it would be beneficial for European regulators to be clear on the role of central banks. I think that's beneficial for all. And then if you want to facilitate the cooperation between the public and private sector, then I think these negative interest rates is something that you need to address. It's not helpful, and actually has not been helpful even for the economy. That has not worked very well in Europe. But there are ways around it, and one thing to support this industry in Europe would be to do what is possible in the UK now, and has been for some time, is for e-money issuers basically to deposit or use the reserve or the accounts with the central banks to safeguard the underlying funds. I think that would be something that they should consider, to have that as a main rule, and that would be helpful for our European stablecoin, if you will, or European e-money tokens.
Thanks, John. Maybe Markus next, and then Julian before we go to the Q&A.
And your question was basically, what would we like to see from the regulator, but also what would we like to see in general?
In general, what has to change that
yes,
the situation is different? Yeah,
I think we've seen very good adoption of stable coins, of US dollar-based stable coins, and we've heard, for example, from Julian, the numbers of USDC in different industries. A lot of this is based, for example, on trading today, also on crypto trading. What we or what I would also like to see is actually end user adoption of this technology. In the end, in crypto, the overall industry in a way failed to bring the everyday user to crypto and have real use cases. And I think here, making this technology easier to use, make this technology also safer to use and have the legal clarity or the regulatory clarity as well, are important steps, because then we can actually see a lot of potential use cases, exactly those we've already chatted about. And therefore, it's exciting to see that we also now see more traditional companies that are not from that space entering that space. Deutsche Telekom here in Europe is one example recently, and therefore this is for me very exciting, that because it's very important. Many of these algorithmic stablecoins depegged because there was no real use cases for it.
Thanks. So Julian, now you have the last word before we go to the Q&A.
Well, I'll tell you what, the first word would have been easier, because following Markus and John that have already covered the topic so well is really, really challenging. I guess the only thing I'll add to that is just more transparency. Again, the technology is very complex. There's still a lot of education and awareness that needs to occur on what a distributed ledger technology is. Transparency in stablecoins, I think, is really, really important, getting down to how do we ensure the trust in the particular stablecoin that we're leveraging. And to one of Markus's point with Deutsche Telekom looking into this, you may have seen that Amazon posted one of their jobs around digital currency analyst. And so when you start thinking about one of the biggest companies in the world that's looking at this, a lot of speculation around, will you be able to pay for something on Amazon? My belief is yes, and I believe it's coming. I think digital currencies are here to stay. But out of the 6,000, 7,000, 8,000 different cryptos, I think little by little, you're going to start cutting down to a handful or maybe a dozen in different type of currency, fiat-backed, that are really going to be the superstars. And I think that's going to be built on trust and transparency, usability, and consumer feeling comfortable using something that is still fairly novel in the industry.
And you could see at the market reaction that this Amazon job post actually moved prices, that this is relevant for this industry. Yeah.
Cool. Yeah. So thank you very much, Julian. This was really also good closing words before we go to the Q&A. So thank you for sharing your insights on stablecoins. I think this was really interesting for my side and also for the audience. Yeah, so let's now turn to the Q&A. And first, I would like to introduce Destan, who's also part of the Digital Euro Association team and will jointly with me moderate the panel, and also really did excellent work with putting up this event. So let me again share my screen so that you can all see the questions. Again, to everybody, if you still have questions, just use this Slido code or scan this QR code. And you also are very eager to upvote your preferred questions, which is really good. So please continue to do so. And yeah, then we are now continuing. We have 15 minutes left. So I would kindly ask you to be like as precise as possible so that we can actually address as much questions as possible, if this is fine. Right. So the first one, I think this goes to Markus, and here's the question about the CELO. So is CELO, so I assume the CELO Euro 100% pegged to euros, or with some bonds and other securities, kind of probably referring to this USDC and USDT debate we have seen.
Yeah, thanks for this. And in general, CELO is, there are multiple currencies living on top of the CELO blockchain. CELO itself, the CELO native asset, is the governance asset of this blockchain, of this platform. And there are also stablecoins, CELO euros and CELO dollars. And CELO euros are not fiat collateralized. They are a hybrid between an algorithmic and a crypto collateralized stablecoin, which means there is a decentralized protocol that is based on smart contracts that adjusts supply of the stablecoin to varying levels of demand and therefore keeps the price stable. So there are no bonds, no other securities. It's all based on smart contracts so that people can actually verify how the mechanism works.
Thank you, Markus.
Okay, so the next question is, I guess, coming to John, because it's about e-money tokens, and it says, what is the real difference between stablecoins and e-money tokens from a user perspective? And is it the case that they mostly differ in the way they are regulated?
Yeah, so both e-money tokens and stablecoins are meant to be money on blockchains. The difference is, yes, they are regulated differently. There are multiple regulations and some are not regulated as stablecoins. If it's the e-money, the only company that is allowed to call themselves e-money are the ones that have gone through the process and are under the surveillance of a financial supervisory authority in Europe. So e-money is just money. It's just like, you know, the money you have on your debit card. A stablecoin is in my mind a proxy for money, and a part of the law is, for example, that e-money is to be issued and redeemed at par. It's not approximately 1-to-1, it is just 1-to-1.
Thank you very much, John. The next question, I think this goes to kind of everybody. And here's the question: isn't there a technological dependence on the underlying tech when it comes to transaction costs? Because on-chain transactions are kind of expensive. Does anybody have thoughts on this one?
I could try to tackle this one, Jonas.
Sure.
So currently, so the answer is yes. There's clearly some technological dependence on the tech when it comes to transaction costs, which is why with stablecoins, there needs to be some type of revenue that is generated from stablecoins. And so, if you take the example I had when I was in Mexico, you know exactly how American Express makes its money on transaction fees because they're running their own infrastructure. Visa runs its own infrastructure, MasterCard runs its own infrastructure, and financial services right now, their solutions are very siloed and it's like walled gardens within their particular banks. Therefore, on stablecoins, for example, the transaction fees we're promising very low or almost nothing. I think Markus alluded to just a couple basis points at the outset. There has to be some type of revenue to ensure that you are continually investing with capital type of investments in this underlying technology. Therefore, that's why the discussion about reserve assets and the reserves generating a return versus taking payments has been so widely discussed over the past several years.
Thanks, Julian.
And maybe to add here, it's basically the gas fees or transaction costs for these on-chain transactions does not only depend on the underlying technology in terms of size, it also depends in terms of currencies. So there are blockchains, for example, where you have different currencies for the transaction itself and for the transaction costs, which in many applications works very well. And for example, on Celo, you can pay for a Celo Euro transaction in Celo Euro, which might be a small technological innovation, but in terms of usability, it's actually big because you don't need to hold a different currency to pay for the transaction fee.
Thank you so much. And the next question, I'll combine two different questions because they are very connected to each other. So will there be any integration of central bank digital currencies, CBDCs, or digital euro and stable coins using an interoperable platforms? And what will be the key consideration for this integration? So the question is open to anyone who would like to step in and answer the question.
So one point Julian already covered that is very important, and I would like to stress again here, is interoperability. So if a central bank would issue a central bank digital currency based on blockchain technology, they could consider also a decentralized ledger technology based on this interoperability, because then you would have many different applications that live on this technology talk to each other and make it interoperable. So I think the consideration here is if you have a technology that is interoperable with many other systems, that makes use cases much easier and broader accessible. But sorry, I saw Julian, you also unmuted.
Yeah, I was just going to add to that, Markus. Interestingly enough, I think if you want to build an infrastructure that is for public good, then you need interoperability, which really, really begs the question, would the European Central Bank sit down with the large players in Europe to ensure that what is developed is very similar to an HTTP type of protocol, right? Where no matter the browser that I'm using, I can access the internet. It should be very similar with any discussions of CBDCs or stablecoins, that you should ride on open rails in order to have that interoperability, which currently you just do not have. The merchants choose who they want to use as their payment service provider.
Thanks, Julian and Markus. One question, what's the link to join the DEA? This is to us, so we already posted it on YouTube. You can also join our website and Google us, and then you have an application tool where you can just basically apply as an expert or a fellow. So this was not the question on top, but now I will come to it. So here the question I think is really good one when it comes to regulation. So probably to the people that are really good aware what MiCA is about. And here the question is, given the majority of stablecoins are backed by US dollars, would the regulation MiCA affect the use of US dollar stablecoins in Europe? Good one. Anybody wants to answer that or aware of it?
Well, my understanding is that it will, but as we know, it's not out there yet, and it may change.
And then maybe also depends on the type of stablecoin. Is it considered to be an asset reference token? Is it considered to be an e-money token? That then probably also determines how it would be regulated, or if it's none of these.
Thank you very much.
Thank you. So the next question is asking the difference between a mutual fund and a stablecoin in terms of ensuring the stability or the risk associated with stability. And you can jump in.
I guess I will take that one. Yeah, the risk guy and the guy that has the master's in finance, right? I better know the difference between the two. They're in fact very different. So a mutual fund has diversified holdings into it, and it's really an investment type of vehicle, versus a stablecoin is not meant to be an investment. It is purely meant to be a payment type of mechanism. Therefore, you hear a lot about backed one-to-one with very low fluctuation. In fact, you should have no fluctuation in a stablecoin versus a mutual fund, of course, that has fluctuation based on market environment and market conditions.
Thanks, Julian. So I would say, let's maybe have two more questions. So, or maybe one, depending how long the answers are. To Markus, your presentation was focused on financial inclusion, e.g. in Africa. Do you want to bring the sale of US dollar and euro to Africa? And what are European use cases, despite cross-border payments, I guess?
Yeah, I think all these applications we mentioned, remittances, saving, lending, borrowing, remittances in a cross-border way, but also transactions within country, payments at merchants. All these are great use cases for Europe and for European or stable coins in Europe. When it comes to the Africa part of the question, so that is a nice feature in general of the Celo blockchain. There can be different currencies sitting on top of the Celo blockchain. So we would like to see, after Celo dollar and Celo euro, also a Celo real, a Celo peso, and other currencies. So we would actually like to enable many different countries to be able to do transactions in a stable coin that is also stable to their currencies. But the nice thing is the technology in general could also be stable to a local basket of goods in a certain country in Africa, which might also be interesting. We have a lot of projects in Africa that develop solutions on top of Celo because there are areas where people have less access to the traditional banking system, and therefore having technology that is mobile first and enables transactions between mobile phones is perfect, especially for Africa. So we actually would like, with this technology, enable both use cases in Europe, across the world, and in Africa as well.
Thanks, Markus.
And so the last question is coming to John. As you said that stablecoins provide a safer money than bank deposits, how can actually the stablecoins become safer if they are also backed by bank deposits?
Well, actually, I didn't say that. And I don't think I mentioned it here, but I mentioned before that e-money tokens, they can be safer than bank deposits. And the reason I say that is that according to the rules, then you're allowed to safeguard the underlying funds in a bank or in high liquid quality assets with a short duration, and in some jurisdiction at the central bank. So it depends on the rules and what you outline in your application, how you safeguard the underlying funds, how safe it is. And in our case, we prefer high-grade liquid bonds, governmental bonds. And obviously, if you have a counterparty risk with a fund, basically the underlying fund was safeguarded in let's say, a governmental bond, and that's safer than any bank.
Great. Yeah, so thank you very much all for this really excellent panel, and also for these excellent questions, of course, by the audience, and also your excellent answers. So thanks, Markus, John, and Julian, for being here with us. Really also great audience, and really lots of people stayed until the end, even if it took 90 minutes. We took a deep dive. So thanks for taking the time. It was really our pleasure to have you. And maybe one last comment to the audience about our upcoming events. We will have like a small kind of a summer break in August, but afterwards we will continue with at least 3 events in the winter. The first, or in autumn, the first one will be about privacy and CBDCs, because this is a really essential topic currently. So what the implications are, which different concepts exist. Then afterwards we will go back to the private sector, as we currently do kind of a mixture of both, and discuss how commercial banks can basically participate in this. So addressing, kind of tokenized commercial bank money, we could end up seeing also in a very short time horizon, or maybe the medium term would say. And the last event will be about wholesale CBDC. So basically, if you want, how central banks kind of leverage DLT for their respective use cases, something we also tackled very, very briefly today. So this is like the roadmap for the next few months, starting in September. So yeah, of course, thanks for joining today. You are, of course, all welcome to join our Digital Euro Association. Also follow us on social media so that you can see all our activities, and also follow our newsletter to be up to date. And yeah, so again, thanks, Markus, John, Julian, for taking the 90 minutes to be here, providing your insights, and yeah, continue your great work. And I'm really looking forward maybe to have a similar panel next year.
Thank you, everybody.
Thank you very much. Bye-bye.
Cheers.